Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by the man, the myth, the one, the only, Darius Dale. Darius, welcome back to the show.
Mike, it's such a pleasure to be here, man. Thanks for having me. It's a really kind introduction. I don't know if I'm a myth or a legend, but I am certainly a man.
Yeah, how many people have introed you as the man, the myth before?
I was pretty good at football, so probably quite a few.
It's like a ton back in high school, yeah. All right, man. We've got a lot to cover, so I just want to jump right into it. So we had the FOMC this week. I would love to just get your thoughts on sort of the tea leaf divining that we always do whenever Jay Powell talks and takes the microphone, and then we can get into your expectations around rates.
He's starting to look tired, isn't he?
Yeah, he is.
This is a guy who's been having internal struggles for like better part of like a year and a half now. So it's like it's starting to wear on him, and I'm starting to feel for the guy. But
I'm shocked anyone wants to do this job. I'm not going to lie. I can't even imagine the stress of doing that, but good for him. God bless him.
God bless him. God bless him. And he's doing the best he can, as all the Federal Reserve policymakers. But that doesn't necessarily mean that they're going to achieve the best outcome. So I put together some charts. Let's just hop right into the charts. I think it's probably easier to explain that way. So let's just get right into the FOMC yesterday. So obviously the big takeaway was the Fed hiking its 2024 and 2025 median dot, both by 50 basis points. So now the Fed is effectively calling for 5.25 for 2024 in terms of the year-end Fed funds rate. And they're also calling for 4% in terms of the year in 2025. They left their longer run projection unchanged. So that tells me that this is a Federal Reserve that still sees the world returning back to the state that it was in prior to the pandemic. I happen to believe, and alongside with Jim Bianco, who's a friend of the show as well, that we are not going back to that state for a variety of reasons, which we can talk about in a second. The next chart just shows the Fed now only sees 2 cuts in 2024 in terms of going from the current terminal or the terminal rate to the year-end rate of 2024, and then they see 7 cuts in total by the year in 2025. Now that doesn't necessarily matter as it relates to market participants because the Fed is going to remain data dependent, as are the markets throughout this process. But that will have implications for the bond market, which we'll get to in a few slides. Before we get there, let's just hop right into their summary of economic projections.
Yeah.
So the Fed raised its median real GDP estimate by more than double for 2023. That number went to 2.1% from I want to say about 1.1, but right around 1% prior. We increased it 40 basis points to 2.5% in 2024 in terms of the year-end estimate there. And then they still see sort of the trend rate of growth, long-term trend in terms of productivity plus working age population, right around 1.8%, which is where we've been really for the past 10 plus years. The Fed lowered its median unemployment rate estimate by 30 basis points to 3.8%, catching down in the unemployment rate terms, catching up in GDP terms to the resilient U.S. economy thing that we've been talking about, all year, really since back to last summer, actually. Feds they lowered their unemployment rate forecast for next year to 4.1%, which is consistent with where they see it settling out at, which is interesting, right? Because the Fed is effectively saying we're going to get more growth, less labor market deterioration, but somehow we still have this immaculate soft landing path in inflation. And so they took down their core PCE forecast for 2023 to 3.7%. They have that decelerating to 2.7% by year end 2024. And then now they kind of have it settling out at around 2.3% by 25 and then eventually getting back to 2% by 2026. I don't know where they're getting these 25 and 26 estimates from. Like, I build models for a living. We have no real foundational basis to forecast that core PCE out that far, aside from just sort of, extending the trend, which we can argue the trend has very much changed in the pandemic. So that's neither here nor there. This is by the way, most of these sort of wonky academics use these autoregressive tools to forecast. We have autoregressive tools that we use to forecast as well. But the reality is, if the underlying trend changes, the autoregressive tool is going to be wrong. And I think the Fed's going to be wrong on this expectation here without a recession. And, one thing I was, in terms of the recession view, if you think about this sort of concept of the Fed thinks inflation is going to be well behaved. The Fed thinks, growth is going to be better than expected. The labor market's going to be better than expected. but ultimately they're going to have to keep interest rates higher for longer despite that, or really higher for longer as a function of that. You put all that stuff together, it doesn't really make a lot of sense, right? If like we're going to get better than expected outcomes on inflation, better than expected outcomes on growth, better than expected outcomes on employment, and better than expected outcomes in terms of the level of the policy rate. Now, none of that really jives if you think about it just from a, macroeconomics 101 sense. But the only way you can sort of get to that outcome is one of two things happens. And the first thing that happens is job openings, which is the red line in this bottom panel here. They continue to bear the full brunt of labor market rebalancing. So we all know the labor market's out of balance, right? If you look at the total labor demand relative to labor supply, that's at 170 million relative to 168 million. And so the imbalance there is plus, right around plus 2.5 million workers in favor of the labor market demand. So we still have this, imbalance there that is, keeping private sector wage growth elevated relative to its longer term trend. Now, if the red line here, again, JOLTS, total job openings, continues to go down, and we just have a modest acceleration in total employment, which is the blue line there, you can actually get to a dissipation of that imbalance back to and potentially through zero that will allow the blue line here, again, private sector employment cost index, to get back to a more normalized level. That's what's been happening, by the way. So if it continues to happen, then, the sort of Goldilocks, Pollyannish expectations that we're getting out of the Federal Reserve's summary of economic projections can happen. Now, I don't think that's the modal outcome, and you and I will talk about that in a second. But the final slide I'll show in this discussion is or two. So again, you only get to this Goldilocks Pollyannish outcome if we continue to see JOLTS job openings bear the full brunt of labor market rebalancing, or the U.S. economy experiences a productivity boom. And the way I say, and the reason we say that is, if you go back and you sort of look at what causes big spikes in inflation, it's typically, the sort of concept of a wage price spiral. It's sort of loose. It's there's academic research out there, but it's very inconclusive. But we can know just by, kind of eyeballing the chart, which is whenever we've had these big spikes in inflation, that's the red lines and the black line in these charts. It's typically as a function, or at least it's correlated or, co-integrated with, the big spikes in the spread between wage growth and productivity growth. And that makes a lot of sense, right? If your labor is generally the largest cost for most businesses, it's somewhere between 50 to 60 to 65% for most businesses. And so if wage growth is growing really quickly and you have that outpacing productivity growth, i.e. the goods and services that the workers are creating, then what you're leaving the economy with the supply and demand imbalance. You got a lot more demand in the economy, a lot less supply, and ultimately prices have to rise in terms of having to offset that, not just in terms of the actual quantity of goods and services being demanded and supplied, but also in terms of to offset that from a margin perspective for the corporates. So there's a path to a soft landing, and then there's a path to a hard landing, and the path to a soft landing requires JOLTS continue to bear the full brunt of the labor market rebalancing process, and we get this productivity boom that, again, it's impossible to forecast, and I'll give you one final stat on this whole discussion. Productivity has averaged somewhere around 1.5% over the last 5 years, 10 years, 20 years, and 40 years. So we are a 1.5% productivity economy. If, you basically need to get to 3+% productivity if we keep wages at this level in order to get inflation back down to 2% sustainably. And so again, that could happen, but there's no real foundational basis to say that it's going to happen.
Yeah. All right. That was a lot of great information, Darius. I want to sort of break that conversation to a couple of different parts and sort of move through them sequentially. And one is just the Federal Reserve and what's going on with interest rates. So there's what we actually got from the FOMC, and I want to poke at it a little bit and get your expectation of where you think rates are actually going. Yep. Sort of tied into that is the discussion around inflation and what is the actual rate that you think we're going to get and how much the Fed has control over that. And then finally, how that translates into sort of the real economy. Labor market maybe is the link in between. Labor market wage growth is sort of linked between inflation and the real economy. So starting with this FOMC, right, we obviously got, we're staying pat, but the market generally expects that there's going to be one more hike this year in November, and then probably we start cutting halfway through next year. I would love to get a sense of how accurate you think that is. And then what I want to ask you about is sort of the long end of the yield curve here, which has been spiking up. So maybe just start with what do you think we're going to get in terms of rates? And then we can talk about the long end of the curve.
Yeah, great question. So I like that you broke it up across the curve, because I do believe there are some interesting curve dynamics to get through before we get to those rate cuts. We do believe that's a fairly accurate assessment, where we would take offense to the current pricing if you look at Fed funds futures of that expectation of starting to cut mid-year. that expectation is based on a soft landing pricing in terms of, inflation really is doing exactly what the Fed wants it to do. The Fed's going to be able to be allowed to take some steam off of the tightening program in terms of, not allowing real interest rates to get too tight as we move forward in time and as inflation falls down. So that's what's priced into the curve right now. So we agree with that directionally, but we also believe what's going to happen is that what the current pricing is misguided in the sense that we're going to see a lot more rate cuts than what's currently priced in our view. Because we do believe that a recession is the modal outcome, right? I don't think there's been a human being on earth that has been more accurate about the resiliency of the U.S. economy than I have, we have at 42 Macro for the past 15 months. And we still believe that a recession is the modal outcome for a variety of reasons. Number one reason is the most accurate forecaster of the recession, the business cycle, continues to be deeply inverted, which is the 10-year 3-month Treasury yield curve. It's 8 for 8 for the last recession, and since its inception, it's 8 for 9, which is as good as a forecast for the business cycle as we have out there. And based on our analysis of the business cycle, we did a big backtest study last fall, in fact, in November of last year, and the conclusion of that study was that the recession had the highest probability of commencing in this sort of 13 to 18 month forward interval from the date of inversion. So you can sort of slice and dice, GDP, employment, the things of that nature, kind of traditional economic statistics that the NBER would use to sort of date a business cycle. And historically, what we saw is that the interval that has the highest probability of seeing a real GDP contraction and a rise in the unemployment rate is the 13 to 18 month forward interval that corresponds to November 2023 through April 2024. So until we get to May 1st of 2024 and there's no recession, we're still going to have a recession as our modal outcome. And again, we have other models that suggest that a recession is likely, a little bit of spillover beyond April 2024, a little bit of spillover before November 2023, but that is our modal outcome expectation. And so in that context, if we do start a recession process sometime in that interval, I happen to think it's going to be in the latter half of that interval rather than sooner. If we do start a recession process, the Fed will have to do an about-face pivot, panic rate cuts, panic QE. So we're expecting all those things to occur in 2024, and that's not what's currently priced into the market. If you look at what's sort of currently priced into the market in terms of money markets are now basically pricing in only 150 basis points of rate cuts total. Now that doesn't make a lot of sense in the context of historically speaking, we typically seen the Fed cut about 375 basis points in a recession. And historically in recessions where the Fed has caused the recession with monetary tightening, the Fed tends to cut on a median basis 475 basis points. And again, this is against the money markets that, between the max value, the terminal Fed funds rate on the overnight index swap curve relative to the floor value of the overnight index swap curve, we only have a minus 150 basis points. So we got a lot more easing to price in when we get to that recession process. However, not so fast, my friends, as the great Lee Corso would say. Not so fast. We still think there's a considerable amount of fixed income volatility ahead of us before we get to that, that Pollyanna scenario for a bond bull. And the reason we say that, and again, we can unpack any of this in greater detail, but I'll give you the headline, the key takeaway. We still think the U.S. economy is going to prove to be resilient over the near term, over the next, let's call it 3 to 6 months before we head into that recession process. We still think one thing we're starting to see in some of the data that we track is this sort of transition from immaculate disinflation here in the U.S. economy in terms of the dominating the inflation narrative to sticky inflation. We're starting to see elements of sticky inflation. And what we mean by sticky inflation is that core PCE measures of underlying inflation like trim median, CPI and PCE deflator. Those measures are starting to stick and stabilize at levels that are inconsistent with the Fed's 2% mandate. And so that's, I think by more than likely by year end, everything I just said will be consensus about inflation. Right now, we're still debating immaculate disinflation, and you're starting to hear a little bit of a sticky inflation twinge out there because of the energy move, but it's actually more broad based in energy. And I think, again, we'll all be kind of dealing with that as investors in a few months. And then lastly, the BOJ. We think the BOJ is going to continue to inject bond market volatility across sovereign debt curves globally, because if you think about where the BOJ is in its tightening cycle, which is very early and also very anomalous to where the rest of the world is in the context of a Japanese economy that has grown. It's currently exhibiting above trend real GDP growth. Its composite PMI reading is at above trend pace, above trend level as well. We have above trend headline CPI and above trend core CPI in Japan. It's the only major economy in the world with those conditions. So they have the most amount of pressure to tighten monetary policy at the current juncture than any other central bank in the world, yet they are very early in their tightening process. So we think Bank of Japan is set up to surprise investors with tightening throughout this fall. And as a function of that, the Bank of Japan transition from macro disinflation to sticky inflation, and ultimately the economy's hanging in there and still being resilient and pushing that recession out in consensus mind, into, maybe in the middle of next year. That, in my opinion, could create some more bond market volatility. You will see some more bear steepening, in my opinion. I think 4.75 to 5% on the 10-year is a very reasonable estimate for this market cycle.
Yeah. Could you walk us through? There's been a pretty pronounced move in longer dated securities. So the 10-year right now at the time of recording is just under 4.5%. If you go back and look, I think it's about up almost 50 basis points just on the month of September alone. Over the course of the last 3 months, it's been about 100 basis point move. What's been moving those longer term rates, and what are the immediate implications for that?
Yeah, great question, Mike. So it's mostly floor policy rates. So in this chart here, I'm showing So in this chart here, I'm just showing the dark blue line is the terminal Fed funds rate as derived by the overnight index swap market out to 2 years. The light blue line is the Fed funds rate, and the red line here is the floor policy rate as derived by the minimum value on the OIS curve out to 2 years. And then we take the spread between the terminal rate and the floor rate. And as you can see, we're currently pricing in right around 152 basis points of rate cuts, in terms of this 2-year forward forecast horizon, for the money markets. That's still, not quite, but it's still a full couple of corporate rate hikes still a couple of rate cuts below where what's currently priced into the ECB, and a full rate cut below what's priced into the Bank of England curve. And I don't see, based on our analysis of the data, you have much more deleterious growth dynamics in both of these economies. In our opinion, we definitely, in our opinion, should be seeing something that looks a lot more like neutral pricing. I don't see any real foundational basis in terms of what I'm trying to say is for the markets to delineate between, U.S. Forward rate curve and the European forward rate curve, on a relative basis to their own economies. So, one of these numbers is wrong. Effectively, is what I'm trying to say. Either the Bank of England and the ECB need to price in more rate cuts and be more like the Fed, or the Fed needs to price out less rate cuts and be more like the ECB and Bank of England. In our opinion, I think the latter is more likely in the context of that resilient U.S. economy, sticky inflation, Bank of Japan tightening, kind of a trifecta that the bond market, in my opinion, is likely to experience in the coming months. And then, in terms of just like pricing, this is something we've been, in no opinion, I'm not a big fan of taking victory laps, but, we will take it when it's due. I think we've been very appropriate to have warned investors about fixed income, particularly, I want to say in the May timeframe, kind of right, in the aftermath of the regional banking crisis. It started to become a little bit more clear that this wasn't the death knell for the U.S. economy. And so, at that time, we were, pretty clear, like, hey, look, this economy is going to remain resilient, at least until the fall, perhaps into the spring of next year, in terms of that recession forecast window that we highlighted earlier. If that's the case, bonds are egregiously mispriced. And that's obviously proven to be correct, right? I want to say something like TLT is down about, 12, 15% since that call. And the reason we were comfortable making the call then is because the pricing in the fixed income market was at the time and continues to be to perfection. And it's to perfection in favor of a hard landing that's going to get bond bulls paid, which ultimately means, like, how are you going to get paid if this is the starting point? So in this chart here, I'm showing a 10-year term premium as derived by the ACM model. There's no such, there's no real term premium to observe out there. And for the listeners, for those who are unfamiliar with the fixed income math, term premium is the excess return you get as an investor for locking in your capital for an extended period of time for, on this particular duration for 10 years, relative to just rolling that same amount of capital over, for a 3-month T-bill or something like that for a shorter maturity. So it's effectively saying, hey, look, the market is effectively saying there's an excess amount of demand for treasuries on the 10-year relative to supply. So much so that term premium, even today, after this backup that we've seen every months, is still negative. Yeah. It's still minus 28 basis points. Historically, the mean term premium in the bond market is somewhere around plus 152 basis points. And why do term premium widen? Why are term premium so tight currently? Well, when we did a big empirical study on this back to last summer, term premium tend to be very correlated with inflation. And the reason they tend to be very correlated with inflation is for obvious reasons, which is, well, not obvious reasons. We needed to do the research to get to this conclusion, but it is sort of obvious when you kind of arrive at the point, which is when inflation's high, you have higher volatility in both nominal and real economic growth. And all term premium really are just the sort of volatility associated with forecasting nominal and real economic growth, right? In the ultimate path of policy rates. And so we're effectively arguing that if we're in this higher inflation regime, which we are arguing, and we can talk about our structural views on inflation as well, we are in this higher inflation regime. It's very unlikely that we can keep term premia negative in the context of a Fed, that's consistently shrinking its balance sheet in terms of its treasury exposure. And then one final thing on inflation, in terms of the bond market, in terms of the steepening we may see, you still have inflation expectations, whether they be market-based or implied based on, some of these wonky models that the Fed uses. They're still kind of coalescing around this 2.25 level. Well, our math suggests that we should be coalescing around 3.25 when you think about where inflation is likely to trend over the very long term. So that, in my opinion, is another reason why you could easily see some more bear steepening in the treasury market, really, across global sovereign debt markets globally. But I do believe the treasury market is especially vulnerable, given kind of the, given this expectation amongst institutional and even retail investors that a recession continues to be right around the corner.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. In terms of the sticky inflation, I would love to poke at that a little. I went to a investor summit this week here in New York, and I listened to someone from, I don't want to out him specifically, but he's, one of the chairman of one of the largest, most successful private equity funds in the world, and very accomplished, sort of investor who's been there. And he talked about his outlook for inflation, and the way he described it was we've moved essentially from inflation sort of stabilized around before the Fed really started to push it down around 6%. We're at between 3 and 3.5% right now. So the mental framework for people should be, we're about halfway done with the work that needs to get done. And similarly to a diet, the first 10 pounds are a lot easier than that stubborn last 5 pounds. So there's still, as we all know, right? So there's work still left to be done on the inflation front. And I know you've been a proponent that it's going to be stickier. So obviously there's a little bit of a divergence right now in between core and headline. Energy prices are driving headline back up. Core has been a little persistent. I mean, I'd be curious to get your thoughts on why inflation is sticky, and maybe it's the lagging shelter indicator. Why is inflation going to be much stickier? And then where do we ultimately end up shaking out inflation-wise? Do we abandon the 2% target that the Fed, sort of did this on a long time ago? Or
it was the Reserve Bank of New Zealand.
There you go. So
and we all copied them, even though they did this.
That's what everyone does. I think there are two types of people in this world. There are people who think that models inform everything and everything's very data driven, or people that do this at the very top, and I'm in that camp. But I'd be curious what you think, Darius, just about why is inflation going to be much stickier?
Yeah. So to me, you're sort of asking two questions. There's a cyclical outlook for inflation, and then there's a structural outlook for inflation. So let's attack the cyclical outlook for inflation first, because that has nearer term market implications. So we're showing this chart here, our Hope plus I framework on inflation. And what it's designed to do is help investors understand the progression of various cycles or in and around a recession in the U.S. economy. And so what these lines represent is the median trailing 10-year delta adjusted Z-score of a basket of indicators that represents each of these cycles. Now, that's a total mouthful. This is finance stuff. But all I'm effectively saying is, what's the normalized level of the indicator adjusted for the directionality? So, for example, jobless claims, you need to invert them so that down is bad and up is good, right? So that up is bad and down is good, right? And so we have to delta adjust all the various indicators. And there's about 10 to 12 indicators in each of these baskets, something in the inflation basket, like private sector wage growth, core PCE, headline CPI, things like that. So what we're trying to do is effectively see, okay, how do these indicate, how does these various cycles in the economy behave in and around recession? What leads, what lags? And what we find is that housing tends to break down around 18 to 16 months ahead of a recession. Orders tends to break down around 8 to 10 months ahead of a recession. production and profit, though that basket of indicators tends to break down on balance on a median basis around 4 to 6 months ahead of a recession. Employment tends to break down right on time. That's kind of the bullseye. And it makes sense, right? The NBER is using, a lot of labor statistics to kind of date the business cycle. But ultimately what we find is that inflation is the most lagging indicator. It tends to break down to a below trend pace, to a below trend level 6 to 8 months after a recession starts. And so if you just burn this image into your head, we've long thought, despite having this trend immaculate disinflation plus resilient economy equals transitory Goldilocks view since January, we've long thought that inflation would eventually settle out at a level that is inconsistent with the Fed's 2% target, irrespective of the move that we're seeing in energy. So this is still part of our base case scenario, and part of the reason why it's our base case scenario. And this is sort of looking at another way of looking at that analysis. What I'm showing here in this table is a collection of indicators and cycles in the economy that how they behave during and after, before, during, and after recession. And kind of trying to understand what is a recession, right? We use this where we throw it around, but what actually happens to things like GDP, non-farm payrolls, corporate profits, the market itself, inflation, the Fed funds, et cetera, in a recession. So there's a lot of information in this table, but the most important, as it relates to the cyclical outlook for inflation, the most important column in this table is this column here, which is the basis point change of core PCE inflation in the year leading up to recession. And what we find is that on a median basis, it's plus 5 basis points, which effectively says core PCE is usually flat to up leading into a recession. And in fact, there's only one negative value in this entire sample, and that was leading into the 1981-82 recession. So there's a lot of time series history in the U.S. economy that says you generally don't get very positive inflation outcomes before a recession, which is another reason we believe that inflation will, even though it's been immaculately disinflating because of the, some of the lagged effects of the pandemic are coming out of the time series, things like auto used car pricing and airfare pricing, hotel pricing, a lot of stuff that's just been wicked hot. It's really just coming down back to normal. But we don't believe normal is the previous 2% world. And again, that's a structural discussion we'll have in a second. But, so with these two charts in mind, understanding that inflation is a lagging indicator of the business cycle, we'll go into what's actually happening on the ground, boots on the ground in the real statistics. So in the most recent inflation print, I think it was the August print, we saw the 3-month annualized rate of change of headline CPI accelerate to 3.9%. And again, that's on a 3-month annualized basis. So whenever you see these charts from 42 macro, the red line is year over year. The blue bars are the 3-month annualized rates of change. The 3-month annualized rates of change contain all the information that we're looking for as market participants. The year over year is fun to talk about. It's easy to model, but the reality is stuff that actually matters to the bond market and really to global markets are the sequentials. And so we have to keep a good eye on what's actually developing there. And we're starting to see some interesting developments on the sequentials. Energy inflation popped up to 25.4% 3-month annualized. And this is after a year plus of negatively compounding energy inflation. So that's a problem, right? We know that you have a headline inflation problem brewing in the months ahead. But what's also starting to be kind of an issue is a couple things. So core CPI continues to decelerate. We're now at 2.4% 3-month annualized. We have negative core goods inflation at minus 1.9%. Core shelter inflation continues to decelerate. It's now at 4.4% 3-month annualized, well below the year-over-year rate of 7.2%. But what I'm starting to see is sort of stasis in places that we don't want to see stasis, man. So this is core services CPI. So this is core services less housing. So super core. That number has gone up 2 consecutive months. Now it's at 2.2% 3-month annualized, which is slightly below the pre-COVID trend, the trend we observed from 2015 to 2019, but it's moving in the wrong direction. And not only is it moving in the wrong direction, we are starting to see stasis in trend mean CPI. And so if you look at the last 4 months of trend mean CPI, we've basically been trapped around kind of like somewhere between like 2.7 and 3.2%. We're at 2.9% now. So it's effectively telling me the inflation basket is having a really hard time like getting back to 2. And you're starting to see that in the data. You wouldn't be able to tell this by looking at the year-over-year numbers because they're going to continue to decelerate in the months ahead. And folks who aren't paying attention to the right information are going to miss the call. But what's happening on the margins on the ground is that we're starting to see some stasis in where it really matters and where it really counts in terms of the Fed's reaction function on inflation. And one final thing I'll say, and just in terms of these data points, you look at core PPI, ex trade service, so super core PPI, so, less food and energy and trade service, that number popped up to 3.3% in August. And again, this has nothing to do with energy or, eventually, energy will filter through into these numbers. But, again, this is not good as it relates to the cyclical outlook for inflation in the context of everything I just said about this table and in the context of everything I just said about this chart. So in my opinion, I think in the next few months, at some point by, again, I want to be too specific because it's impossible to model sequentials with any specificity on timing. You could be good on timing, or you could be good on the actual number. And it's, it's hard to do both. In the modeling terms, trust me, I've tried. I think at some point in the next few months, it'll be pretty clear that we're moving the wrong way on a trending basis in terms of these sequential inflation readings, and not just because of energy. It'll be because, the broader economy is experiencing this sort of second round of inflation, or maybe not even a second round. That's probably too much of a statement. It's just we are experiencing a higher level of inflation that we're not going to shed or get rid of until we go through a recession.
Yeah. I tend to agree with you there, Darius. And there are, some of the other, even much longer term trends, right? Like people like to cite demographics, a little bit overdone, but I believe that's a thing. I mean, we're reshoring and reconstructing our supply chains in real time. There are longer term pressures, even in addition to what we discussed. And what I'd like to get your sort of translation to is, okay, so maybe a recession. So inflation is going to be stickier than we all probably expect or would like. That leads to some sort of, I think you referred to as the modal outcome, like base case, sort of a recession at some point, within the next 12 months or 18 months, say. But what do asset prices do from here? Like this has been a very interesting year just in terms of the stock market, right? So obviously our economy has been much more resilient than we thought. I don't think anyone saw, maybe you did at the beginning of this year, stock prices performing just as well as they did. It looks like they might have peaked and are now on the downturn. I mean, how do stocks, bonds, commodities do from here, like next 12 months, do you think?
Yeah. So, I don't take too much credit. Like we authored the call. There's others that beat us to it. Raoul Paul had the call right back in October of last year. Milton Berg had the call right back in October of last year. I co-authored a call with Bob Elliott on our program in January. So it took me, I had a terrible Q4 being bearish. It was terrible. It's probably the worst 3 months of my career, but I learned a lot. We improved our models as a function of that. And it's really benefited our clients throughout this year. So in terms of how we see asset markets evolving, you have to go back to the basis, right? Like what really drives asset markets. And this is something we do statistical analysis on a daily basis at 42 Macro. Right now, what's driving the stock market higher, the stock market, let's just pick on the stock market. What's driving the stock market is cyclical growth expectations in terms of, the log price change correlation. We run this big multi-factor correlation matrix based on log price changes, and cyclical growth expectations are by far dominating the S&P. So if growth can hang in there and even, continue modestly improving on an expectations basis in terms of investors having to keep pushing out their recession view, because there's a lot of folks who are very bearish on what's the new narrative? Government shutdown and the consumer having to pay back their student loan debt. There's all these bearish narratives out there for Q4, and if those things don't tank the economy, on an expectations basis, you're going to have a positive shock to growth. And so I do believe that there's probably still right tail risk to price in the equity market in the context of the history of equity markets leading up to recessions. I'll throw some statistics at you. Historically speaking, when you go back and you look at the 12 post-war business cycles in the U.S. economy, on a median basis, the S&P 500's return in the year leading up to the recession, to the wherever it peaks right before the recession, or sometimes they peak right during the recession, it's plus 16%, with an interquartile range of plus 14 to plus 20%. Plus 16% is more than double the median, the average annual return of the S&P. So the S&P basically goes asymptotic as shorts are getting their faces ripped off leading into a recession, because a lot of folks put the bear trade on too early. Thank God we did not. And so that's obviously happening again this year, obviously. You think about, how asset markets are likely to behave in a recession. The median return on the S&P 500 during recession, or, kind of what we call the phase 2 credit cycle downturn, which is the credit cycle. This is what happens in a recession, that the median return on the S&P is minus 24% with an interquartile range of minus 19 to minus 39%. And you can bet your bottom dollar that those observations are correlated to the starting valuation of the market. And this is a market that's, not particularly overvalued, but it is overvalued. It's not very overvalued. It was very overvalued in 2021 leading up to 2022's crash, but it is still quite overvalued. If you look at the S&P 500's next 12-month PE ratio, we're in the 71st percentile of all the historical data going back to, I want to say, the early 1990s in terms of how far we can get that data to go back. So, we're expecting somewhat of a blow off top prior to a crash. Now, again, you can put a gun to anybody's head and they'll give you a specific time frame or a date, but let's just say we can rally into through year end, and that's probably it. But again, I don't want to be too specific about that. We know we have systems that are going to help us, get out of, land the plane safely in terms of the risk management we need to not blow up in that eventual crash, which I do believe is probably going to take place sometime during the first half and or middle of 2024. That's neither here nor there. Crypto to me is a little bit more interesting because crypto does not have this institutional performance chase dynamic, right? Like this year, and we've done a statistical analysis of this. This year, 2023, has been the most, we've never seen Wall Street sort of lag, the Wall Street median sell side estimate for the S&P lag the actual S&P price for this long of a period of time. Like Wall Street has never been more bearish and wrong on the stock market than they've been in 2023. And this is data going all the way back to 1998 that we have the statistics for. And so what we find is that, if you use that as a representative sample for, you're just your general money manager out there, a lot of them have been looking up at the market performance like this the whole year. And so in our opinion, we think there's a behavioral dynamic that we need to layer on in terms of our market expectations, particularly for the U.S. equity market. When I say this, I'm really specifically talking about U.S. equities. I could care less about what Brazilian equities are going to do. They're probably going to suck when if anything I said, or, some other smaller cap, index, because it's, it doesn't have these performance chase dynamics. But you got a whole institutional investor community out there that is severely lagging the benchmark return. And they're going to have to make a choice as we move forward in time. If growth doesn't tank soon enough and on par with their expectations, that they're going to have to capitulate this fall and chase Santa, higher. But again, that might be it. That might be it for this bull market, in my opinion. Valuations will be very unsupportive at that point as well. Again, transitioning to crypto. Crypto, the number one thing that's driving crypto right now in terms of our big correlation matrix is the terminal Fed funds rate. Not the floor Fed funds rate, but the terminal Fed funds rate. So crypto is scared out of its mind for more policy tightening out of the Fed, because every time the Fed tightens policy, it's usually as a function of, the economy being more resilient. And ultimately that's just pushing out what crypto really wants, which is the liquidity, right? Crypto wants QE, crypto wants rate cuts, crypto wants, the world awash with liquidity. What crypto loves is an economy in shambles where liquidity is being created and has nowhere to go in the real economy. So it flows into financial markets and ultimately into digital assets. That's the panacea for crypto. Every bull run we've seen in crypto sort of starts from that point in the business cycle. In our opinion, we're probably at least a year away from that. We're probably a year away from that process in terms of where inflation might be at the beginning of the recession. So in our opinion, I think, it could be a long struggle for crypto. It's not necessarily saying crypto is going to crash while the stock market rallies. In our opinion, that's unlikely to happen. But what's more likely to happen is that crypto continues to languish and just be volatile like it always is in the year leading up to halvings. I had a big talk with Pomp on that regard earlier this year. Crypto is extremely volatile. Bitcoin in particular is extremely volatile in the year leading up to halvings. I think by this time next year, we're having this conversation on September 21st of 2024. I'll probably be saying, no, we got to get ready to go. That's pivoting. I mean, when the Fed pivots, the whole world will know, right? Like, I don't need to tell you. I won't have to get on that. But if you need to have a game plan to risk manage your digital asset exposure between now and then, this is what we're trying to do, and based on our analysis of the economy. So that's crypto. We talked about the bond market. Currency market is pretty interesting because you have divergences in the currency market that should continue in terms of, I don't really see a reason why the euro needs to rally sharply, or the Chinese yuan needs to rally sharply, or the British pound needs to rally sharply. The one reason I think I can get behind is we've seen growth expectations in those economies come down pretty sharply in the last 2 months. We track nominal and real GDP growth expectations on a time series basis here at 42 Macro. And they're now getting to levels where I'm like, if these economies don't go into recession, they're going to have a trend of positive economic surprises. And if we have a trend of positive economic surprises in those economies, you're going to start to see the dollar struggle in that scenario. That's a positive. That's a tailwind for global liquidity. It's a tailwind for those currencies, and ultimately a tailwind for those asset markets. So I don't know enough to make that call yet. Check back with me in like 2 months, or not 2 months, but like 2 weeks, maybe. I think we're kind of at the very early innings of getting that information.
Yeah. Darius, unfortunately, we've got to wind down here, but always learn a ton talking to you. And what I really appreciate is there's like a good amount of just sort of subjective context, but a lot of hard analytics and rigor that goes into your thoughts. So I always appreciate that. And as listeners know, Darius has been on the program many times. I can't recommend 42 Macro enough. But Darius, if folks want to follow you or subscribe to the service, what is the easiest way to do that?
Yeah, easiest way to do that is check us out at 42macro.com. I'm on Twitter at Darius Dale 42. all one word. We try to put out a lot of educational content outside of our paywall, but generally speaking, if you want to know exactly what to do with your asset markets, your portfolio, we're very specific about our factor recommendations, our ETF recommendations as well. We run a systematic portfolio construction process for our clients. Definitely come check us out, because I think a lot of folks could need and could use the help in terms of how to asset allocate. 2023 has obviously been one of those years where folks, I think, if they're being honest with themselves, they could definitely step up their macro process.
I agree with that. Guys, I highly recommend that you go check it out. Darius, always have fun when you come on the program. Appreciate you, man. And we'll have to do it again soon.
Absolutely, Mike. Appreciate you, man. Thank you.
Cheers.